The headline here is Trump expands 50%. Steel and aluminum tariffs to include 47 additional product. I got a problem with that guy. He's signing all these forms. Cleveland, Cliffs. President Donald Trump has once again expanded his trade war. The White House confirmed that tariffs of 50% on steel and aluminum now cover hundreds of additional products. What began with raw materials now includes car parts, refrigerators, baby strollers, even the aluminum and soda cans. For American families, this means higher grocery bills and more expensive cars. For U.S. partners like Canada, it disrupts exports that depend on metal packaging and industrial inputs. And why doesn't he just stay in the U.S.? Because I'm done with this guy signing letters saying, yeah, bring all the steel down to U.S. Tariff the crap out of Canadians. This is not just a technical trade measure. It is a shock that links everyday costs with international trade tensions. Let's take a closer look at what this expansion means inside the United States and across North America. The Trump administration is quietly making it even more expensive to import hundreds of items that all of us would see on store shelters. Well, a whole bunch of household items impacted and some industrial items too. Look at this. Trains, bulldozers, wind turbines, rail, cars. For consumers, the most immediate effect is inflation. CNN's reporting highlighted that import prices rose sharply in July, defying the White House claim that foreign exporters would absorb the tariffs. Analysts such as Pantheon Economics stress that American businesses and households are carrying nearly all of the cost. That cost is not small. Supply chain experts have estimated that the expanded tariff list now covers around $320 billion of products, creating roughly $160 billion in extra expenses that flow directly into the economy. Industries tied to steel and aluminum are already reacting. Farmers and builders depend on tractors, gearboxes, pumps, and construction machinery now hit by higher tariffs. Legacy manufacturer John Deere recently announced layoffs at 3 Midwestern facilities, citing weaker sales and the impact of tariffs on production costs. When major employers respond this way, the shock spreads into local communities. The administration stated goal is to rebuild American steel and aluminum, yet investment in those sectors requires billions of dollars and long-term certainty. The process so far has been anything but certain. Economists describe it as a policy direction that may be defensible in theory but clumsy in execution. This uncertainty, now often called Trumpian uncertainty, discourages companies from expanding or hiring because tariff rules can change with little warning. We aren't going to roll over. We're not going to kiss his backside. We're going to fight like we've never fought before. Trump's tariff expansion has not gone unanswered. Canada, America's closest trading partner, has pushed back on two tracks at the public level. Ontario Premier Doug Ford has taken direct aim at Washington. He calls the tariffs a hidden tax on American families, noting that Canada buys more than $350 billion of U.S. goods each year. Ford announced a $70 million Canadian program to support workers, pressed Ottawa to tighten quotas on cheap steel, and made it clear Canada will not roll over. On the federal track, Prime Minister Mark Carney has chosen strategic patience. He has directed aid to sectors such as lumber and agriculture while keeping negotiations with Washington open. His government insists Canada will only accept a fair deal, not a short-term fix that weakens national interests. Ford and Carney show two sides to one response. Other provinces have also voiced strong opposition, while unions Industries and policymakers align behind the same message. Canada is standing firm, defending its workers and industries and refusing to be cornered into a bad deal. The expansion of steel and aluminum tariffs is more than a policy adjustment. For Americans, it means higher prices when inflation is already a concern. For businesses, it adds uncertainty that discourages long-term investment. For Canada, the answer has been resilience. Ottawa and the provinces are backing workers and reinforcing supply chains, sending a message that they will not accept a bad deal. Trump's strategy may unsettle markets, but it also reveals which partners are prepared to stand firm. The coming months will show whether these tariffs strengthen industry or simply confirm that trade wars rarely produce clear winners. At some point, his view is maybe a tariff is better than a deal. Michigan's governor has directly raised the alarm with President Donald Trump after the damage his tariffs will do to the auto sector in America's car capital. In Michigan, the heart of America's auto industry, the pressure is building. Over the summer, President Donald Trump's latest tariff measures have landed with force, and the numbers tell a sobering story. General Motors reported its second quarter profits fell by $1 billion, attributing much of the decline to new import taxes. Stellantis said it lost $2.7 billion in the first half of 2025, also pointing to tariffs as a major factor. Ford's latest results are expected soon, but analysts already anticipate the same pattern. Trump has pitched these tariffs as a way to bring manufacturing back to the United States. Yet in Detroit and across Michigan, the early impact is hard to miss. Rising costs squeeze margins and a growing unease that these measures may be hitting home harder than they are hitting foreign competitors. The new import taxes rolled out in the last several months could lead to more factory floor job losses, price hikes, and lower profits. The problem starts with the basics of production. Since June 2025, imported steel and aluminum, critical for vehicle components, have carried a 50% tariff. Canada, the largest aluminum supplier to the United States, is now facing a 35% rate on non-USMCA goods as of August 1st. Mexico, though given a 90-day delay on new tariffs, still faces the threat of 50% duties on certain metals. And auto parts if talks fail. Outside North America, India's rate has been raised to 50%, affecting some automotive parts and materials that U.S. manufacturers rely on, even items far from the assembly line, leather, textiles, and interior trim imported from Asia are caught in the net. The complexity of modern supply chains means that a car labeled Made in America can still depend on dozens of foreign sourced elements. Many U.S.-based suppliers themselves import critical subcomponents now taxed heavily before they ever reach a Michigan factory floor. So far, auto companies have been eating the impacts of the tariffs, and that's what we're seeing in the latest profit reports. It's only a matter of time until the companies pass those costs off onto the customer. At first, the big three absorb these new costs, hoping to protect sales. But according to the Center for Automotive Research, the 25% tariffs on autos and parts alone could add $18 billion to industry costs in 2025. That figure doesn't even account for the knock-on effects from 50% steel and aluminum duties or the layered tariffs from multiple trading partners. The Alliance for Automotive Innovation warns that these costs will inevitably reach consumers. Higher sticker prices could push entry-level models off the market entirely, reducing choice and slowing the rollout of new technologies. Electric vehicle makers face an extra hurdle. The U.S. still lacks a large-scale domestic battery manufacturer forcing reliance on imports that now carry steep tariffs. In Detroit, cutting production means more than fewer cars on the lot. It means fewer jobs, especially in communities that have spent decades rebuilding after past downturns. Analysts say the next 3 years could bring sustained declines in sales and employment if current policies stay in place. Trump sees tariffs as leverage to pressure trading partners into investing in the U.S. and opening their markets. Canada's Prime Minister Mark Carney, however, has stayed firm, keeping most Canadian exports tariff-free under USMCA and seeking new trade routes abroad. He maintains that the steep duties on Canadian metals and parts ultimately raise costs for U.S. consumers and manufacturers more than for Canada. It's a test of two strategies: Trump's high pressure push for quick concessions versus Carney's long-term approach built on stability and alliances for America's auto sector. The outcome will shape whether these policies deliver stronger domestic production or deepen the cost and job losses already taking hold in Michigan and beyond. America is the country that started the AI race, and as president of the United States, I'm here today to declare that America is going to win it when it comes to AI data centers. They are in order of magnitude more power hungry than the data centers we're used to since the internet age. After August 1st, negotiations with China and Canada remain at a standstill, and Trump's latest tariff moves are now colliding with America's rising demand for energy and critical minerals to fuel its AI and manufacturing ambitions. Behind those headlines is a reality Trump can't afford to overlook. The United States relies heavily on Canadian supply, and in the race to lead in AI and semiconductor production, losing that connection would hurt Washington far more than Ottawa. I think the biggest concern, and the one that the industry itself really needs to address, is the energy usage. That is just huge. The industry and the energy producers have got to figure that out. They've got to find a better way of providing that energy. Trump's latest tariff push is now colliding with America's surging demand for energy, the same power needed to fuel AI data centers and bring semiconductor manufacturing back home. His proposal for a 100% tariff on imported chips is designed to pressure companies into building or investing in U.S. facilities. Apple, for example, pledged $100 billion in new American projects. That kind of industrial build-out comes with a hidden cost. Electricity. In Virginia, home to the largest data center market in the world, Dominion Energy projects that demand could double over the next 15 years. AI data centers alone can draw more than a gigawatt on a single campus. And Virginia is only one example. Across the United States, from Oregon's server farms to Texas's tech corridors, AI data centers are multiplying, each requiring massive and continuous power. Furthermore, bringing semiconductor fabrication home will add to the load. All of it depends on reliable, large-scale energy supply, and that's where Canada's role becomes unavoidable. So, when I talk about being an energy superpower, I always say in both clean and conventional energies. So what does that mean? Yes, it does mean oil and gas. It means using our oil and gas. It also means more exports. Without question, Canada is already America's largest energy supplier. According to 2024 trade data, the U.S. imported roughly 3.8 to 4.3 million barrels of Canadian crude oil per day. Natural gas imports from Canada averaged about 8.5 billion cubic feet per day, up 7% from the year before. Electricity flows across the border totaled about 11.44 terawatt hours, enough to power roughly 1 million U.S. homes for a year. Uranium from Canada made up around 27% of total U.S. imports, the largest share of any country, sustaining a big part of America's nuclear fleet. On top of that are critical minerals. We bring as interlocutors here all of the critical minerals of Ontario. So, for example, nickel. A nickel is something that comes from Ontario. It's high grade, and it's not replaceable from other places in the world. Ontario's high-grade nickel has no domestic substitute in the U.S. for certain defense and battery applications. British Columbia's germanium is essential for fiber optics, solar panels, and night vision systems. And the Teck smelter and trail is the only Canadian source. These are not commodities that can be swapped in from other suppliers without years of supply chain adjustments. If these flows were disrupted, the ripple effects would be immediate. Industrial plants, data centers, and chip fabs would face higher costs and possible delays in replacing Canada's unique mix of proximity, scale. We could be an energy superpower, and we have all the components in nuclear in a hydro and a potentially in carbon capture and storage, which is going to be one of the determinants of competitiveness. Prime Minister Mark Carney has chosen not to rush into a deal. His strategy is to keep dialogue open but refuse terms that would weaken Canada's long-term position. He's accelerating investment in domestic extraction and processing of energy and minerals and reinforcing Canada's value to allies beyond North America by signaling readiness to cooperate, but also the capacity to stand alone. Carney is making clear that Canada is not cornered. The message to Washington is that Canada's resources are shared strength, but only if the partnership is respected. Pushing too far could backfire. Without Canadian energy and minerals, U.S. industries risk higher costs, slower growth, and greater dependence on less reliable partners. A dangerous prospect for an administration promising a manufacturing revival and AI leadership. In this mutual dependency, Canada holds leverage that matters more to U.S. stability than the other way around. And Trump must decide whether the price of sidelining Canada is worth any gains at the table. This guy's coming at us. I just want to go on record. He's coming full bore at us. We got to move quicker. And folks, be ready. He's not waiting till 2026. At any given time, President Trump, he could pull the carpet out from underneath us on Kuzma tomorrow with one signature. Ontario Premier Doug Ford didn't mince words. In a press conference that cut through political nuance, he warned that President Trump could end the COSMA trade agreement, not in 2026 as expected, but as early as November 2025, and he may not even follow a formal process. All it could take is one signature. Ford called on Canadians to brace themselves. This wasn't a normal trade dispute. He said, it's something far more volatile, coming from a provincial leader with strong ties to business and conservative circles. The message landed with weight. The concern is not hypothetical. Ford isn't just worried about tariffs. He's worried about COSMA itself, the legal backbone of North American trade. Almost every country in the world that's trying to negotiate with this administration. It's very challenging. You think you're getting close to a deal, and then the cheese slips off the cracker when it gets to the president's desk. So, I think Ford's right. That concern is echoed at the national level. Conservative strategist Corey Taney said it plainly. The worst may still be ahead. Trump's approach isn't rooted in conventional trade norms. He's abandoned negotiation frameworks, rejected predictability, and applied pressure without offering a path to resolution. The 35% tariffs impose on Canada under. The AIPA are just one example. The deal-making process now moves according to Trump's timeline and his mood. It's not just Ford who's lost trust. There's growing doubt across Canada's leadership that any deal with this U.S. administration can be relied on after all. Trump is threatening to override agreements he once championed. CUSMA itself was signed under his presidency. Canada and Mexico themselves have about $50 billion in two-way trade. So that's nothing to sneeze at. It's highly unpredictable, and so both sides need to sort of get together and figure out what the hell's going on. While Trump escalates, Canada and Mexico are recalibrating. This week, Canada's foreign affairs and finance ministers traveled to Mexico for high-level talks. The agenda wasn't ceremonial, it was strategic. Trade officials and business leaders from both countries sat down to align supply chain goals, discuss trade, infrastructure, and build a united response to what one expert called a toxic atmosphere. Both Canada and Mexico are being hit with emergency tariffs. Though Mexico was granted a 90-day pause, yet the message is clear. Neither country trusts the current state of U.S. trade policy. In place of that trust, they're forming their own foundation, one grounded in mutual reliability, not coercion. But building that foundation takes time, and time is exactly what the markets may not have. On July 31st, the U.S. Court of Appeals reviewed the legality of Trump's emergency tariffs. Lower courts had ruled against them, but let them proceed, citing ongoing talks with China. If courts strike them down, Canada might be better off waiting than rushing into a bad deal. Ottawa now faces a dilemma: take a risky agreement or wait for legal clarity that may never come. We can either wring our hands up and lament the fact that the U.S. administration is doing this, or we can get to work on building our own economy by getting started on projects that, frankly, should have been done 20 years ago. Inside Canada, the message is starting to sink in. Yes, provinces have different priorities. Alberta wants to protect oil, Ontario its auto and steel industries, and Quebec its aluminum. But Ford noted that 98% of what's needed is shared. The divisions are shrinking. The urgency is growing. Large-scale national infrastructure projects, long stalled, are being revisited as a way to build internal economic strength and reduce dependence on unpredictable trade flows. It's not just about defending sectors anymore. It's about defending sovereignty. Trump couldn't force Canada to fold with tariffs, and now facing a firm but calm Canadian government, he may try something else, dismantling the agreement entirely. Ford's warning was blunt because the stakes are real. Without CUSMA, decades of trade predictability could vanish overnight. Canada and Mexico are no longer reacting. They're preparing, because when trade becomes a power game, stability becomes strategy. And in this game, survival may depend not on what Trump does next, but on how Canada and Mexico respond together.